Imagine multiplying your investment returns without using your own money. Intrigued? That's the power of financial leverage. Financial leverage is the concept of using borrowed capital as a funding source to amplify returns. Businesses often use leverage to invest in expansions, acquisitions, or other growth methods. Leverage can also be an investment strategy, using borrowed money to increase potential returns. Key takeaway: leverage uses debt to amplify returns from an investment or project. Companies can use leverage to invest in growth strategies, boosting their equity base. Some investors use leverage to multiply their buying power in the market. There are various financial leverage ratios to gauge a company's financial strength, such as debt to assets and debt to equity. Understanding financial leverage is crucial for both investors and companies. Investors use leverage to significantly increase the returns on their investments. They leverage their investments using instruments like options, futures, and margin accounts. Companies use debt financing to invest in business operations, influencing growth without issuing stock. Investors uncomfortable with direct leverage can invest in companies that use leverage in their operations. The goal of financial leverage is to multiply potential returns, but it also multiplies potential downside risks. A highly leveraged company, property, or investment has more debt than equity. To calculate financial leverage, various ratios are used, such as the debt ratio. The debt ratio indicates how much debt a company uses to generate its assets. A debt ratio of 1.0 means the company has $1 of debt for every $1 of assets. Another important ratio is the debt to equity (D/E) ratio, comparing borrowed funds to raised equity. A D/E ratio greater than 1.0 means a company has more debt than equity. The debt to EBITDA ratio compares a company's debt to its income before operating expenses. A high debt to EBITDA ratio indicates a high degree of leverage. The equity multiplier analyzes how assets have been financed, indicating ownership weight. A low equity multiplier means a company has financed a large portion of its assets with equity. The degree of financial leverage, DFL, ratio measures the sensitivity of a company's earnings per share to changes in operating income. Consumer leverage ratio evaluates a household's debt relative to its disposable income. Advantages of financial leverage include amplifying profits and accessing more expensive investment options. However, leverage can also amplify losses and result in higher downside risks. Leverage involves fees, premiums, and margin rates, making it more complex and expensive. Margin is a special type of leverage using existing cash or securities as collateral to increase buying power. An example of financial leverage is buying a rental property with a small down payment and borrowing the rest. Financial leverage can boost equity base but comes with high risks. Weigh the pros and cons carefully.